What's going on, guys? Welcome back for a new YouTube video. So in this YouTube video the topics will be the supply and demand flip. So basically we are gonna start to see what is the flip, how to identify it with some schematics step by step, and then we're gonna see how to draw it directly on the chart. The first thing we need to note is what is the flip. So the flip is basically the market flipping from one direction to another, suggesting a shift in market structure. It is observed as a significant turning point or potential opportunity for traders to take advantages of the changing market. The flip can be observed with the supply and demand area. The turning point on this zone indicates clear zone that can be very relevant for the price to reverse. There is a few steps that you will be able to follow in order to identify a flip in market structure. The first step to identify is a clear market structure with supply or demand. On a bullish market, we will look for demand and vice versa in a bearish market. So basically on the model here, we can see that we are bullish and we are just marking the demand. Vice versa into the bearish market, we are trending, making lower low and lower highs, and so we only mark the supply zone that make the last low. The second step is to wait for a reaction into the zone and a failure of this one after the reaction. So it is really important to get a reaction from the zone in order to validate that zone, because if you see the previous video, a supply or demand zone is a zone where a lot of liquidity is seated, and that's why those zones are powerful. And if the price doesn't move into the zone, if price just break after them without any rejection, that means that this is not a valid zone. So to assume that this is a valid zone, we need to identify a reaction that is not able to set a new high in a bullish market structure, and then a failure of that demand that was not able to make a new high. Same thing for the bearish market. So basically we need to wait for a reaction on a valid supply. The reaction will validate the supply. From this reaction, price has to not be able to break its market structure, and then it has to break the supply in order to make the flip. And now the first step, where all will be completed, where all the schematics will be done, is only to mark the zone that has flipped the previous zone. So basically, if you are bullish, when the demand will fail, it will create a new supply zone, and that supply zone will be the place of the flip. And in a bullish market, we call that a demand to supply flip, because price taps into a demand, fail to break above, and then create a supply. So this is a demand to supply flip. Vice versa into the bearish market, when price reacts to the supply, don't set new low into the market structure and then break the supply, it will create a new demand that we will be able to follow in order to follow the flip in the market structure. And this flip will be called the supply to demand flip. Supply failure to demand flip. Basically, you can find this model on every time frame, as market are fractals. I'm gonna show you a few examples here. I think it's always better to have a real market example, because the real market is not always as the schematics, so it's really important to train your brain to take care of this zone. This zone doesn't need to be added to your plan if you have a profitable plan, but this is a very interesting concept to add to any strategy, or to try if you want to add another concept, or if you think that you need something more into your training plan. For the first example here, so basically we were trending into a bearish market, making lower low and lower high. So at some point price start to lose its power, So what I'm gonna do in this case is to mark the last supply in control. So the last supply in control will be this supply zone. So we have a break in market structure, valid supply zone. I need to wait for the price to make a reaction of this supply zone. As we can see, the supply zone was not able to set a new swing low into the market structure here. That occurs that the price could be in a change. And here, as we can see, we have the first sign of changing trend. And after that, price build liquidity in order to come back into the demand that has flipped the previous supply. And as we can see, this is the perfect schematic that we have just before, but just with some more high and lows. But this schematics is clearly visible in many ways, and you can add probabilities to this zone. So as momentum in your move, as liquidity, there is probabilities that you can add in order to have the best zone possible. But the only thing that it's important in every case is the reaction, because if you don't have the reaction, that means that the zone you have taken is maybe only liquidity, and that the price will not be able to use that in order to continue its move. So if you take a supply to demand flip from this area, you will just end up as a losses, because this was just liquidity and not a valid zone to trade. This is what we wait a reaction from that zone. This is a model that you will be able to see on every time frame and on every type of instrument that you will trade. It can be crypto, it can be forex, it can be indices. You can find it everywhere, and it's tradable on every time frame. Let's go straight to the second example. So on the second example, we can see that we were trending up, so market was making higher high and higher lows. We had a big manipulation in price. That manipulation occurs a big sweep of liquidity, and then a break in market structure that creates a valid demand zone to trade. As we can see, price returned to the zone very slowly, and once we got a reaction, price don't even show us any big move to the upside, react a second time into the demand zone, and then flip the zone. So from that zone, here this is more a complicated example, but we will not take the first touch here because everything is mitigated, so we cannot take anything from here. But in this case, we will take the last supply that is takenable, and the last supply that is takenable is this one. With this one, we have a break in market structure, we have the flip, we have momentum, we have liquidity, so we have many stuff that shows us that the supply is really good to trade. And in this example, this shows a demand. So we have the demand failure that creates a supply. So this is a demand to supply flip, D2S. So now when you see a D2S or S2D, you will understand that this is a flip in the market structure. So this is a concept that can be a little bit hard to input if you are a total beginner. So focus firstly on the supply and demand, make sure that you understand this concept very clearly, and then you can start to look after the flip into the market. The flip can add very nice probabilities to your setup, but it has to be done with clear rules and it needs to be tested. For the last example here, I'm gonna make one in a higher time frame. So as we can see here, we were trending up, market was making higher high and higher lows. From here, so we make a break of structure from that, so price react to that demand and then make a break in market structure. price here start to show that the bullish impulsion lost a lot of power, and price we need to take some imbalance and to recover. And at this point here we cannot use that demand zone here because this demand zone already creates a high. This one here doesn't make relevant bus. This is the one that make the bus. So the last one that we have here will be this one here. And this will be the demand that will be used for the flip. So you can mark also this one, but as you can see, you don't have really relevant reaction from that. So this is hard to find some POI to trade in order to follow the flip in those kind of cases. And this is the case where I want to show that sometimes stuff that seems to be POI are in fact a liquidity. Okay, so from that we can see that the price has reacted to the demand, makes a high, failed to break above the swing high, and after we add that demand failure. Price attempt to react from the supply zone, but it was in fact a building of liquidity to induce even more people for the price, sorry I take the wrong tool, for the price to take the liquidity and the flip of the market. So here this is a flip on a higher time frame. So if you don't trade the higher time frame, you can look for flip on a higher time frame and then look for your entry on a lower time frame. This is all on you, but flip in higher time frame are very powerful when they are placed well. This is a really important concept to understand, but it takes time to master it. So it takes time to backtest it and take time to take the right zone in order to take the right flip. Okay guys, before letting you know, just to let you know that the DexterFX Academy has evolved as never. So we are making now live session before the trading session, and I'm also sending some of my trade on gold and also on the other pairs that I will trade in the future. So if you want to enjoy with us and all of the team, you can take your subscription now, and if you take the 3 months or yearly subscription, you will have my Smart Money Bible concept for free. So if you want to take part of that and be able enjoying a community of traders that are trading the same strategy, click in the link in the bio and enroll for a subscription into the mentorship. I'm also gonna take screenshots of all the materials that we see in the video and make a file about that. So if you want to take the file, click in the link in the description that will redirect you to my account manager, and it will send it to you. I really hope this concept was understood by everyone. So if you have any further question, don't hesitate to ask them in the comments. I really hope that video helps you, and see you on the next video, guys.